Hello, fellow rebel capitalists. Hope you're well. I'm here with my good buddy, Robert Breedlove, who just got done probably with one of the greatest interviews of all time. And I'm not saying that being over dramatic. It was just jaw dropping. And if you're not subscribed to his podcast, you need to do that right away. So, Robert, let's start off by just plugging your show.
Well, thank you, George. I appreciate you having me on. The show is the What Is Money Show. So I had this crazy idea. It's been about a year now to just try to get to the bottom of that rabbit hole. Right?
Yeah.
Sounds like a seemingly simple question, something we use and touch, think about, and think through every day. But very few of us have actually stopped to consider what money is. Right? We think about it a lot. Or we think through it a lot, rather. You're thinking in dollars. You're thinking about getting dollars. What am I going to do to make money, etc. But I don't think a lot of people have really taken the time to press pause and say, what is money?
That's right.
And
Jeff points out the central banks haven't even done that.
Exactly. And then the conversation with Snyder. I mean, I've been a long time fan of Snyder. His Eurodollar University conversation. I think I listened to the whole thing.
Yeah.
Yeah. What was that? 8-10 hours of content, maybe?
Yeah, that's probably 3 years ago or so.
Yeah, I think I listened to that 4 times. I mean, he's so impressive. So I take absolutely no credit whatsoever for the Snyder series, but that's kind of the niche I've established for myself, is doing these long form multi-episode series with guests. And my thinking there is just that the bandwidth for communication now, the cost has gone to basically zero. So why not just give all the bandwidth that the content warrants?
Yeah, right.
And just go, right? I'm like, my thing with my guests is like, let's just talk about this. I don't care if we record 3 hours a week for a year and it's a multi-100-hour series, so be it, if the content demands that.
So
that's working. It seems to be working. So
well, it's phenomenal. It's absolutely phenomenal. And I don't subscribe to that many podcasts, which I'm sure you don't, just because we don't have time because we're creating content so much. But yours is a podcast that I subscribe to, along with Macro Voices and Making Sense and whatnot. But if you haven't heard Robert's podcast, and what's so awesome about his interview with Snyder, first of all, it had to be like a 3 or 4 hour interview. I think you've published 3 of the parts, but how many parts are there?
I think we did a total of, I want to say 10 hours together.
10 hours.
10 hours, and we've released probably 4 or 5 of those hours. So there's another, call it 4 episodes coming.
Oh, that's fantastic. And what Robert did, guys, just so you know, is he kind of took Snyder through a timeline, or through the history of money, at least within the United States, and said, okay, kind of what was it like prior to the Fed? What changes did the Fed make in 1913? Then kind of walked through the Great Depression and World War II, the 1940s, the 1970s, and then taking it into, Volcker coming in and trying to, quote unquote, break the back of inflation. And was that real? And then 80s, 90s, and kind of takes us through this walk through monetary history. And what's great is when Robert is asking the questions, he's doing it the way that I think questions should be answered or asked. And that's not where you've got a script and you're like, okay, what question's next? Oh, yeah, that one. Okay, I'll just read that, regardless of where it's coming in the conversation, if it is even appropriate. You can hear Robert thinking through what Jeff is saying at all times. And so the conversation just kind of is very organic. And one of the things that makes it so educational is because, Robert, you're like all of us. You don't know, or you don't understand everything that Jeff is saying. And what's great is you completely get your ego out of the equation. And if you don't understand something, even if it seems basic, you're like, whoa, Jeff, let's slow down here. I didn't understand that last part. Can you explain that further? And that's really where the magic happens.
Yeah, I'm so glad to hear you say that and pick up on that particular theme, because that's another fundamental aspect of the show is, I don't know where I learned this, but there are no stupid questions.
Yeah,
Right? If you
right.
have a question, it's very likely someone else in the world has that question as well. So my litmus test for the show is really, how can I engage in really useful, productive dialogue with this guest such that we're achieving almost like a connection of mind where, I'm surfing the edge of my own understanding,
Yeah.
and I'm hopefully surfing that along the edge of their understanding about a topic. And I think that's the magic you're describing, is like when you see people both at their own edges trying to connect the dots, and it
Yeah,
gets real
right.
fundamental. Like you'll notice in some of these series, I'll spend the first episode just unpacking a word. Like, what is your definition of this particular word? Whether it's
Money.
power or
Yeah.
money or value, whatever it is. And you get really aligned on these, fundamental building blocks of language called words.
Yeah.
And this leads to a very productive, fruitful, long-term dialogue that something happens there. Like I'm learning, like I'm growing. Hopefully the guest is growing or learning something as well, probably less so than me because I'm mostly the one asking. But that creative process, I think, is what that magic is you described that the audience is resonating with.
Yeah, for sure. Because they're if you're asking a question, most likely the audience has that same question in the
Mm-hmm.
back of their mind, but they just obviously can't ask it. So that what I want to discuss next is what you learned from your conversation. And we got Rebel Capitalist live coming up, the next one in Houston here in a couple weeks. But you were at the first that we did back in June in Miami. And the very last panel discussion we had for the event was on the future of money.
Mm-hmm.
And I was up there, you were up there, Snyder and Brent Johnson.
Mm-hmm.
And you were coming from it. You're coming at it from kind of a Bitcoin sound money position. And Snyder kept throwing out this phrase, money elasticity.
Mm-hmm.
And saying, well, Robert, I love Bitcoin, but I don't know if we could get the money elasticity. So I don't know that that can be the future of money. That might be included, but that might not be the final solution. And so I found it fascinating that in this conversation that you had with Snyder a few weeks ago, that he kept talking about this, and you guys unpacked that idea in phenomenal detail. So what did you learn from not only the conversation, but that about money elasticity more specifically?
Yeah, this is a kind of an opaque term for a lot of people, I think. So I found it to be important to unpack it. And, I guess first we could say that the thing about Bitcoin is that it's the first perfectly inelastic money supply we've ever had, which is to say it maybe more simply is like it's just a fixed supply. It is
Right.
an unchangeable supply of money. It's 21 million hard cap. Nobody can change it. And this is core to its value proposition, in my opinion. But Jeff's counterpoint here is that you need some flexibility in the money supply to provide stimulus or relief or credit at times of economic duress or downturn. And so,
or if the economy is to run on all 8 cylinders at all times.
yes.
And I would also include in there, if we could somehow create this imaginary perfect world. And I don't think we can, because we live in an imperfect world, because we're imperfect creatures. But if we could just wave a magic wand and have perfect money, this is how it would behave, I think is what Snyder was saying.
Yeah. Now, I want to be clear. And I would clearly let Snyder speak on his own behalf, but I think that's his position that, yes, inelastic money is good a lot of the time, but sometimes you need some elasticity in the supply to counter, as a counterforce against economic cycles, something like that.
Yeah.
This is not my position. I actually, even after our discussion, I still don't believe in that, because beneath that assumption is this concept that I'm still trying to peel apart of market failures. There's some belief, I believe, by Snyder, and I've also in my conversation with Eric Weinstein, he believes there are things that the market cannot resolve efficiently.
Yeah,
And I'm
right.
still in the libertarian school of thought where I think the free market is, effectively the ultimate decentralized computing network, right? You have everyone's mind connected by the price signal working on problems, and they're
Mm.
voting with buying and selling. So that's what resolves problems the most efficiently, in my view. But I think Snyder's view is that yes, a lot of the time that's true, but sometimes the market needs an intervention. There needs to be a force into the market that can help it resolve problems that it has where market failure is experienced. So
Yeah. But I had a slightly different takeaway. I heard what he was saying, and I listened to most of your interview with Eric as well. I think that was a few part series. I'm not sure which part I listened to. That was when
yeah,
I
that
was
one's still going as well.
yeah, I was in Puerto Rico when I was listening to that. But when you were talking to Snyder, my thing is, I always go back to what Thomas Sowell says, and what I learned from him when I first started getting into economics. And this is that there are no solutions; there are only trade-offs.
Yeah.
And I always try to remind myself of those words because I think it's so true.
Mm-hmm.
And when you were talking to Snyder about the differences between uh, inelastic money and elastic money, it reminded me of the debate within the Austrian community of whether there should be full reserve banking, which would be
Mm-hmm.
inelastic money,
Yep.
or fractional reserve banking, where there would be elastic forms of money supply.
Yes.
And the take me, and I think this was my kind of main takeaway from that part of your conversation with Snyder, is that if you have inelastic money, you're gonna reduce the boom bust cycle or
Mm-hmm.
the extremes for the
Yes.
boom bust cycle significantly.
Mm-hmm.
The trade off though is that at some times the economy isn't going to be able to grow at full capacity, or isn't going to be able to grow as fast as it may be able to, even in a healthy way. So that you're going to be
Yes.
constraining the growth of the economy, not at all times, but
Yep. Yep.
sometimes, just because there could be a project that could be profitable and
Mm-hmm.
could create goods and services, which would be beneficial, which would increase GDP, let's say, but it,
Mm-hmm.
it can't get funded even at a specific hurdle rate because there's not enough money in the system to fund it at that time. So
Mm-hmm.
let's just say it has to wait for a year or two, something like that, to get funded. Then it's a year or two, and if you look at that in aggregate total,
Mm-hmm.
that could be decreasing GDP slightly in that metric. So, but the trade off there is that yes, you can allow the economy to run at full speed, but because we're all human beings, we're going to overdo it.
Mm-hmm.
You're going to
Mm-hmm.
get the boom bust cycle to a more significant degree. So
Yes.
that's kind of the trade off that people have to decide. Okay, is this, although it's not perfect, is this one
Mm-hmm.
better or is this one better? That's kind of the
Yes.
main takeaway I had from that part of your conversation.
I think it's a brilliant point. There are only trade-offs in reality because every action incurs opportunity costs, right? Whatever
Right,
you're doing
right.
in one moment is necessarily exclusionary to everything else you could be doing.
Yeah.
So, in that frame of reference, the trade-off that I see occurring between elastic and inelastic money is pretty much what you just said. Like, if you have a perfectly inelastic money, you are going to have more frequent bust, right? The
Yeah,
market
right.
will clear errors more frequently, but they
Right.
should also be smaller
Right.
because with an elastic money, you're effectively paper overing some of these economic errors or allocations of capital, and you're delaying inevitable reconciliation to reality.
Mm.
Right now, the other problem to this, and this gets something, there's a deeper point here with what Taleb describes is when we use human intervention to delay volatility in a system, which fiat currency supply expansion is one version of that.
Right.
You're ultimately just, again, you're delaying it and you exacerbate it. There's this example of the forest fires that occur in California and in Mexico. In California, they're very heavily intervened, right? Every time there's a little fire, we put it out, we try to manage it all the time. And it's the same topography down in Mexico, same climate, same topography, but it's unmanaged. There's no human intervention. We let the natural fires burn. Well, what's the consequence? The consequence is in California, we get subjected to these occasional gigantic blazes because you're not letting these little fires clear the underbrush from time to time. Right. So you get this occasional catastrophic conflagration that burns off the topsoil and nothing can grow back. So it's a really bad outcome. Whereas in Mexico, these smaller fires burn much more frequently, but you don't get the big one. So I think this is the analogy to markets. It's like if you have perfectly inelastic money, you're going to have more frequent recessions, which may come at the cost of short-term growth. But I would argue in the long run, you're going to more intelligently allocate capital. Because every time you induce fiat currency expansion, you're misleading entrepreneurs, right? You're creating falsified price signals. People are borrowing and engaging in projects that they can't actually see to conclusion because of the uncertainties introduced by inflation. So, and I think we haven't by the final episode of the series of Snyder, I think you'll see that we come to some common ground on this actually.
Yeah.
Because I think you can have perfectly inelastic base money Bitcoin and just have free banking on top of it, right? And then each bank is free to expand and issue their own currency to whatever extent they want. Customers are free to convert or cast a vote of no confidence, if you will, on a bank, basically withdraw their capital. And the banks that get caught swimming naked will go bust. Their capital will be reallocated into the marketplace. And then through that incentive mechanism, you are incentivizing honest behavior by banks, but you're still allowing some degree of elasticity in the actual currency. And that if there is an economic downturn, these individual banks can issue credit. So I think that's maybe the optimal path between these two polar opposite ends of elastic versus inelastic money.
Yeah, I completely agree. That's the conclusion I came to. Oh boy, I mean, probably a couple years ago when I wasn't thinking about it in terms of Bitcoin, but back then I was trying to think about it in terms of full reserve banking to fractional reserve banking and then central banking. And I thought, you know what, probably nothing's perfect, but the least system, if you want to look at that, is probably free banking that we had in, say, 1837, right at the end of that second central bank between then and the Civil War. We actually had free banking, exactly what you're saying. Of course, back then, base money was gold, but each individual bank would issue its own currency. And then the people that would have their deposits of gold at the bank, they could look at their balance sheet and say, well, is this a reputable company? Is this a reputable bank? Do I know these people? Understanding that they are taking a risk by putting their gold at XYZ bank. Right. And you want that fiduciary that we assume we have today. But back then, I think they were far better fiduciaries because they had skin in the game and there was no moral hazard that was created by a bailout.
Yeah.
I.e.
That's the
GFC.
key point. That's the key point is skin in the game, in my opinion. And this, again, Taleb, he's not so well favored these days in the Bitcoin community, but he's still a brilliant writer. He talks about this. There's no natural system that is sustainable without this balance of incentives and disincentives that he calls skin in the game. This is fucking Darwinism. This is nature, right? Like you're an entrepreneur, you get it. Like you manage yourself off your own balance sheet. You manage your inflows and your outflows. If you make a bad decision, you incur the consequences. Therefore, you're incentivized to make good decisions. If someone removes that mechanism, that potential pain of your bad decision making, and you can dump those costs on other people, like via inflation, then all of a sudden, of course, your decision making deteriorates, right? It's much easier to spend other people's money. I think you could sum it up in that. So.
Yeah. And, another thing that was awesome about that series, just for me personally, was it helped really crystallize some of the ideas that I have had or have been trying to figure out around the banking system and the Eurodollar system. Mm-hmm. And I started, going through this process that I go through when I'm doing a whiteboard video. I this was a whiteboard video, maybe, I don't know, 6 months ago or something like that. But I came to the conclusion that the key with banking, whether it's domestic banking or in the Eurodollar system, to keep things functioning at a specific level, and to keep a degree of integrity in the banking system, you had to have some type of foundation that they could not create. And what I'm saying is there has to be something that the general public can redeem that the
Yes.
banks themselves cannot create. Because remember
Yes.
when Snyder was talking about the Eurodollar system, he said, if you've got a $1 million deposit with XYZ Bank in the Cayman Islands, you're not going to be able to go down there and just redeem it for actual cash. It's all electronic. It's all basically like a central bank digital currency from that standpoint. And I got to thinking, back in a gold standard, that's one thing that would keep the system honest, is that that person had a claim on something that the bank could not create. It could not create gold. But now, even if you have, even if you're in the United States, you've got a claim on something the bank can actually create, i.e., more dollars.
Right.
So I think that is what's absolutely crucial moving forward if we have a solid foundation to build on a banking system. And that's that, and I think obviously Bitcoin would be great for this, but you have to have something that the banks have that they're creating credit on, and they're giving you those receipts, but those receipts have to be redeemable for something that the banks cannot print.
100%. This is another thing that we reach, is the importance of convertibility.
Yeah.
Right? The power of the customer of the bank to be able to call the bank's bluff.
There you go.
If for any reason they suspect that capital is not being fiduciarily taken care of properly, they can cast that vote of no confidence by saying, "Give me my money." This gets us out of this trap of infinite interbank liabilities that is the current system. It's like just debt on top of debt on top of debt on top of debt. There's no call option, right? There's nothing keeping the system honest at the base layer. And to your point, it has to be something. You have to be able to convert into something that supersedes all institutional reality, right? That's what gold is, right? Gold is fucking pure Darwinism, capitalism, nature. It cannot be counterfeited, is the key point, right? So you can think of all this network and complexity of interbank liabilities is kind of like you're counterfeiting money in a lot of ways, right? It's like, oh, you need some more money in your account? Well, I'm a bank. I'll just update the ledger, and you can go and spend it and deposit it at other banks and relend it, rehypothecate, et cetera. So without that call option at the bottom of that stack, the whole thing just becomes really dishonest. And that's what we're in today, right? We're in pure zero reserve,
and shadows and derivatives, and the whole thing. It just gets even.
It's clear as mud and twice as dirty, as I like to joke.
Yeah, yeah, right. But it really puts us in this environment where the bankers are able to run amok. And can you, just to illustrate this point maybe even better, can you tell the story of what happened according to Snyder, going with the Eurodollar system and the banks going into the 1970s? And then probably what's even more fascinating is what happened during the 1980s and then into the 90s, into the 2000s. And just if you don't remember the conversation specifically, it's Snyder what is under the opinion that one of the main reasons we had such extreme consumer price inflation in the 1970s is because the Eurodollar system that was created in the early 1950s was creating all of these dollars outside of the United States. And well, that's one reason why we had 1971, when we had to get off the gold standard, because all these dollars were coming back in that were being created in this Eurodollar system because we still had convertibility. But the Eurodollar system was trying to create all these dollars because they saw, aha, this is a way for us to get rich. So they kept funding projects and projects and projects in the real economy. And note, I said the real economy. But they created too many dollars for the projects, and therefore the amount of dollars created exceeded the rate of production, and therefore you had this consumer price inflation. Now that all comes crashing down in the early 1980s, but then the Eurodollar banksters said, okay, we don't want to fund any of these brick and mortar or real economy projects anymore that actually create goods and services. What can we do? Aha, let's go into financial instruments. Let's go into financial assets. Let's create derivatives. Let's create credit default swaps. Let's create interest rate swaps, etc. And then that takes us to this whole financialization of the economy that we have seen since the 1980s, massive boom and bust cycle, where, to your point, the booms and last a lot longer, but the busts are far more severe.
Yes. No, I guess I should start here with, this is not surprising at all. If you've studied the Austrian literature, it's like Mises wrote about this in 1949 in Human Action. It said, when you start manipulating the currency system, you have one of two possible outcomes. There are no others. You either stop manipulating it and have this deflationary crash back to economic reality,
right,
and the market reestablishes itself, or you keep manipulating it and you get the crack up boom, which is, essentially hyperinflation. You get a big what is perceived to be an economic boom, right? Like in Weimar Germany, everyone thought they were getting rich right up until the end.
Right. That's right.
Then all of a sudden the currency just collapses. It loses all meaning, and it's losing meaning along the way. That's why it's misguiding entrepreneurial action. Because again, you're getting these false price signals that are not emanating from supply and demand realities. They're emanating from policy action. So it's literally, we're injecting this falsehood into the markets, right? The market's this system of competition and cooperation, constantly trying to get to the bottom of things, like what is real, what's true, how much is this nail actually worth relative to everything else in terms of money. When you inject this artificial policy action into the system, it starts lying to you, right? The information, you put garbage in, garbage out kind of thing.
Right. Yep.
And that feeds back on itself. Again, if there's no check on it, if there's no convertibility at the bottom of money for people to call the bluff on the whole thing, the thing just gets more and more deceitful. The money loses its meaning faster and faster until you end up in a Venezuela situation. There's cash clogging the gutters. People are eating cats and dogs. Like, it's a fucking disaster. Yeah. So it's very fundamental. It's like we can't scale human cooperation without money, and we can't manipulate the money without achieving one of these two outcomes. That's really bad. So I just want to lay that out first. It's like, this is not surprising. And Mises did this. It's not like he had a crystal ball. He deduced from axioms, from first principles, and said, here's what's going to happen. And it's a very hard book to read, but if you read it layer by layer, he tells you what's happening right now in 2021, written in 1949. That's got to tell you something. So in the conversation with Jeff, I think he just walks through in excruciating detail the mechanics of that exact history unfolding, right? It's like, we try and control and manipulate the money supply here, but then there's this natural demand for global liquidity, right? Everyone wants, that's what gold was, right? Everyone wanted one money, because money, the more liquid a money is, the more useful it is. So therefore it tends towards one. The dollar was the one, right? But we weren't adequately satisfying that demand for dollars offshore. So what happens? It's as if the free market dynamics flowed around central bank artifice in a way, and it just created another derivative system offshore. So it's like the dollar was a derivative of gold until it wasn't in 1971. And then this Eurodollar system just kind of bubbled up through the cracks as a derivative system on the derivative system to try and satisfy this demand for dollars and global liquidity. And the central bank completely loses control in this arc of history that Snyder describes, to the point where he's saying, like, they have published statements saying, we can't define money. We don't know how much money there is. We don't know where it is. We don't know who has it. So they shift. And what does he call this? They shift from like policy makers to janitors, I think is what he calls them, where they're just trying to clean up the mess. from this system like ripping itself apart for fundamental reasons, again, that Mises identified 70 years ago. So I mean, that was my view on it. Like I'm not, as you've pointed out, like on my show, I'm trying to really get to the bottom of it, and I really appreciate Snyder's technical, in the weeds detail mechanically. He's read every thing of the central banks have published over the past 50 years. He knows who said it, when they said it.
Oh, the
And
Fed
like, I
minutes,
don't
he
have the
reads all that
patience for
stuff.
that. I don't have the patience for that level of detail myself to sit there and do that. So it's so
Neither
amazing
do
to
I.
talk to him and see what Mises deduced from first principles. Him explaining that to me in excruciating detail is just phenomenal.
Yeah. So let's think about the kind of the future of money, and looking at it through the framework of free banking and using Bitcoin as that underlying base money. And then we'll get into some. We've got a few people in queue here that want to ask you questions, so we'll get into that in just a moment. But the way I see this is, if we make a transition to Bitcoin as this base layer of money, people, as you know, a lot of the maximalists say, well, it's great because you take the power away from the banking system, so it's more decentralized because you don't have to store your gold at a specific location. You can basically store your purchasing power in your back pocket. And I totally get that argument, but I think if everyone had their purchasing power in their back pocket to a certain degree, it would still get centralized, because people would want a return on that purchasing power they have in their back pocket. So that goes to, I don't know if you want to call it a bank, but you call it a hedge fund manager. It goes to a private equity fund. It goes to angel investing, something like that, where they could get, and I think they most likely at a certain point would get into the business of creating IOUs on other people's Bitcoin. But maybe not to the extent that we have today. But I think as it evolves over the decades, we would have a system that was very, very similar to what we saw in the 1800s. So let me know if you agree with that. If not, why or why not? And then what would be the advantages, if that was the system, to having Bitcoin as that base layer compared to gold?
Yeah, so I'll answer the last question first. You could just stop at convertibility, right? There are other reasons I think it's more beneficial, but convertibility alone, to make that super economically efficient, available 24/7, that you literally just, if you have your Bitcoin custodied with a bank, presumably you just send your account guy an email saying, hey, I don't want you holding my Bitcoin anymore. Send it to me.
Done.
Send it to my
Done deal.
self-custody, whatever, and it's done.
And the custodian has no control over that, or the fiduciary has no control over that whatsoever.
Well, they have to comply with your request, but assuming you've custodied with a reputable institution, then hopefully they'll comply. So here's where I'm at currently is like, sure, you can self-custody your Bitcoin. There are trade-offs to that decision, right?
Right.
You
Right.
have self-sovereignty. You are independent of everyone else's opinion. You know that you have physical Bitcoin, if you will. There's a lot of power that comes with that, but with great power comes great responsibility. Alternatively, you could choose to leave your Bitcoin on deposit with a custodian. You could borrow against it, do whatever, try to get yield. Maybe they have some yield bearing account. And I think the market will tend towards a little bit of both. Like I would just say where I'm at today, I hold a lot of my Bitcoin in a geographically distributed multi-sig. So that's a self-custody model. But it's a self-custody model that you're not just holding one key. So it's like if you lose one key, it's not all gone. You've cut the key into 5 pieces. You need 3 of 5. And then you distribute those keys in different places. So it's really safe.
Right.
I think the market will go that direction a lot, but I also use a bank. Like I use NYDIG. I have some Bitcoin on custody with them. I'll do certain financial transactions with it. They're a very high touch banking service. So I can just email my people. They take care of the stuff. That's nice. That's a nice convenience for me. Am I taking some risk? Sure. I've left my Bitcoin with a custodian, right? I'm trusting them. But for me, that's an okay trade-off for the conveniences that I get. So on the point of return, I agree with you that we've been very conditioned to try and always seek yield from all assets all the time. I would argue, though, that the basic impetus for that is driven by inflation.
I
Like
totally agree.
whether we consciously understand it or not, we're all kind of forced into this game of trying to outpace inflation. What's the negative real yield in the country right now? In the US, it's got to be 8-10% something. Like inflation's very real, but you can't get any yield on a traditional savings account. So that's a negative real yield. On a Bitcoin standard, or even on a gold standard, the return somewhat gets baked into the money itself or implied in the money, because if the economy is working and it's producing more goods and services and the money supply is remaining constant or relatively constant, or is increasing less slowly than the goods and services in the economy, then that money is a call option on more goods and services, which is to say it's increasing in purchasing power over time.
That's right.
So my argument here would be, okay, then you don't need to get as much yield, active yield, because you have this implied yield. And so maybe another way to think about this is the money's kind of acting like a non-counterparty index fund on the global economy. It's like if the global economy is growing and cranking out more stuff, and I'm holding a relatively fixed share, in the case of Bitcoin, an absolutely fixed share of the money supply, that money should in theory be laying claim to more and more goods and services. So I have yield built into holding the money.
Right.
And I
Yeah, I
don't
want
need
to
to go
point
out
out.
on the risk curve and get that yield.
Yeah, I want to point out to people that even during the 1800s, during this time of free banking that you and I are discussing, there was consumer price deflation in the United States. So the money supply was definitely growing, but the cost of goods and services going down. And I haven't done specific numbers during that time frame, but I have during the late 1800s, and you're basically getting about a 7% real yield,
Right.
because we had about 2 or 3% deflation, and then you get about 4 or 5% in a savings account. So about a 7% real return in a savings account.
Right.
And I would say, okay, well, how much downside risk does a savings account have compared to the downside risk of buying the S&P 500 at all-time highs, a
Exactly.
house at all-time highs, Shiba Inu, GameStop,
Yes.
et cetera. And I think that illustrates your point.
Yeah, absolutely. And okay, 7% may not sound like a windfall, but man, you can retire on that. You accumulate
Well,
to
yeah,
just
it's
today's
compounded.
numbers. If you had
Plug
10
that into a
million
compound
bucks,
calculator. Yeah.
yeah, exactly. I don't know, you spent your life accumulating 5 or 10 million bucks and you're getting 7% on that. You're living good.
Yeah. Yeah. Even if you're someone that's making $75,000 a year. And let's keep in mind too, and I want to point out this is very important, that during that time frame, nominal incomes went up.
Right.
So did
Because
nominal
the economy
GDP.
is doing what it's supposed to do, right? Things
Yeah,
are getting
so
cheaper. We're getting wealthier.
yeah, so think about that. If your expenses are going down, but your income is going up, and you're getting a 7% basically risk-free real return on your money, not only are you able to get a better return, but you're able to allocate more of your paycheck
Yes.
to that savings account every
Yes.
single year because you're spending less money yet making more. So
Exactly.
that increases. So it's very in that environment. Just do the numbers, and if you're making $75,000 a year, and let's say your income is going up at 4 or 5% in nominal terms, and let's say you're able to initially allocate $25,000 a year to that savings account, just compound that over 20, 30 years, and look at what the number is. It's going to be a
Oh, it's staggering.
really, really
Yeah.
big number.
Yeah, absolutely. And I mean, we've hit the key argument, I think, for sound money advocates. It's like in a sound money system, the economy does what it's supposed to do. It allocates capital intelligently, prices deflate. And so the economic surplus being created by this healthy and well functioning economy is distributed evenly among the holders of money, versus in the central bank system, they're inflating the currency supply to harvest that economic surplus
Right.
for a few, right? And it's
Yep.
it's taxing everyone else. This
Yep.
is like it's good versus evil stuff, George. I really don't like the central bank model at all.
Yeah. Yeah. Well, you and I see things, I mean, almost identically when it comes to these topics and a lot of other things as well. But just
Yeah.
with these topics on, what is the best way to move forward with a money system. Um, I don't know if it's Bitcoin. I see a lot of merit to that for sure.
Yeah.
We'll have to see how it plays out. But as far as the core principles, in fact, I think all three of us pretty much would agree. Not that I'm or not that we are in Snyder's at that level. I'm not saying
Yeah.
that, but I think that all of us would agree on these core principles for sure.
Yeah. And I would like to just give you some credit too and thank you. I appreciate your outspokenness on these other areas of intervention that we're seeing in the world today. And I
Yeah.
really believe it is a socioeconomic pathology, like a mass psychosis, if you will. The idea that we can go out into the world and like fucking tell people what to do and that's going to solve problems. That contradicts everything that this country was founded upon, right? The country was founded on the preservation of
Western
life, liberty, and
society.
property. And now we're just completely devouring that foundation. And I really appreciate your outspokenness on it.
Yeah. Appreciate it. Appreciate the kind words. All right, buddy. You ready to get in some questions?
Let's do it.
All right. Josh. All right, sir. What is your name? Whoops.
Hold on one second, George. Just let me sit down.
Okay.
Hey, Robert, how are you? George, how are you?
I'm well.
Great,
What's
man.
your question for Robert?
My question is in regards to the yield curve. So currently, we're all kind of watching it, and we know that the euro dollar curve is inverted already. And my question is, in the next event that we do have, whatever it is when it comes and the yield curve does invert, what are the chances that instead of bonds and the US dollar being the point of safety, could that possibly be a trap and the entire system just blows up altogether, where instead of the 10-year yield dropping below 50 basis points lower than it did in 2020, instead the debt market actually like blows up? Because there's a lot of people who believe this and are talking about it, and the idea that there's a possibility that bonds in the US dollar are not going to be the flight to safety, and that the event these could be the most toxic assets to actually be in instead of them being the flight to safety.
Right. It's a great question. And I think, this has been described as the everything bubble or this possibly even the sovereign debt bubble. And the way I'm looking at this, again, from kind of fundamentals first, is the credibility of, say, the United States as a business enterprise is premised on its expected future cash flows from taxation, right? That's what revenue is. The government is taxation and inflation. That by owning a monopoly on currency, we've been able to engage in deficit spending ad infinitum to get to this point of what are we, 130% debt to GDP, somewhere in that ballpark. And I think, there's been analysis on this done where there's a threshold, I think it's around 130%, that, 99% of countries hyperinflate once they get past that point. So we're there, or we're crossing that line. And I guess the last bubble to blow up would be the sovereign debt bubble, where the Federal Reserve's producing new cash to just buy sovereign debt. We're buying back our debt from foreign holders. And this seems to me to be the last bubble they can blow, because they're literally money balling your own debt. So the market would start to price in perhaps less expected future cash from the tax authority based on things like, I would say Bitcoin is a factor in this equation here. It's like people now have an exit option from inflation. Well, inflation was 50% of the US tax revenue in 2020. Effectively, we printed 4 trillion, we taxed 4 trillion. So now that people have an option to exit the dollar into something that doesn't inflate, that jeopardizes half of the revenue mix for the US government. So then you look at direct taxation, and I think that's why we're hearing these crazy exotic policies being proposed, like taxing unrealized capital gains, right? Things that make no fucking sense at all, that would just annihilate all entrepreneurship, are actually being floated as possibilities. because the governments are desperate. The U.S. government's insolvent, right? It's been insolvent for some time. It's now, its ability to moneyball its own debt and deficit spend further is being compromised and jeopardized. So, my series with Booth opened up with this quote he shared. It was like, I think this is right. Currency wars lead to trade wars, lead to real wars. So when you fuck with the money, you're going to mess up international trade. Trade is the foundation of geopolitical harmony. If we're not, what did Bastiat say? If goods don't cross borders, soldiers will.
Yeah, right.
And so that's where we're at, man. We are at the tail end of this really bad experiment. It's an experiment because it's global, but we know the outcome historically for all the reasons we've laid out today. Like fiat ends badly. We know that outcome. It's just being done at a much larger scale. So I think the sovereign debt bubble could pop. And I think that would be that'd be a big game change. That'd be Bretton Woods 2.0 or something. Something would have to come out of that would really transform the world.
So it's kind of like one of the things where it's either going to be, you're going to have the flight to safety and the U.S. dollar and bonds are going to be safe, or everything's
hard
just
to say. It's so hard to say.
I think you got to take a step back before that though and say what would create an environment where the flight to safety is not the dollar, right? And what you're talking about there is an extreme inflationary environment, because if it's just a collapse in asset prices, you can imagine if the stock market goes down by 50%, let's say global stock markets go down by 50%, as well as global housing market, real estate markets. Yeah. But yet the dollar is still at 95 on the DXY. I can almost promise you that the flight to safety is still going to be the dollar. So we'd have to say, okay, in an environment though, when the dollar is the catalyst to the problems, where the dollar is now not 95, but it's rapidly going from 95 to 90 to 85 to 80 to 75, then all of a sudden it's a different ballgame. And the flight is not into the dollar, it's into something else. And if the flight isn't into the dollar, that's when you get Gresham's law, and the rate of inflation or devaluation of those dollars compound and get more extreme. That's kind of this feedback loop, this doom loop, if you will, where the dollar going down incentivizes more people to sell their dollars.
Yes, right.
And to buy goods, hard assets. And that's the start of Gresham's law. And that's what Dr. Lacey Hunt always talks about when he talks about himself, is his ideas transitioning from being in this disinflation camp to not just an inflation camp, but a hyperinflation camp. So, and in order to answer to go back even further, I think then you got to ask yourself, well, how would we get into an environment where the dollar was going down that fast? And that goes back to, okay, well, how are we creating dollars, right? Because if you're creating dollars strictly through the commercial banking system, creating 97% of them, which is usually what we see, or even throughout the euro dollar system, that's very difficult to get into that environment where the dollar is plummeting like that. It's almost, I would argue, it's almost impossible, because the only way new dollars are coming into existence is by the issuance of debt, which would be a long-term call on those dollars, or long-term demand for those dollars. In fact, more dollars than are being created, because you got interest on top of that. So you'd have to have velocity. So if velocity slows down, then that's going to create even more demand for those dollars. So I think the key here is, how would dollars be created without the issuance of new dollar-denominated debt? And that goes back to a central bank digital currency.
Yes.
And I think that's really the game changer and the catalyst. Robert, what do you think?
I agree with you. And I would actually agree. I think it was Lacey Hunt that said, if there were a modification to the Federal Reserve Act that could allow them to just start paying government debt or expenses directly, rather, that's game over.
Yeah, he calls it taking bank reserves and turning them into legal tender.
Exactly.
Or Fed, I think his exact words, to be specific here, is turning Fed liabilities into legal tender.
Right, exactly. So the direct monetization of debt, effectively, or direct debt monetization. And I agree with that point. I guess if I had to project what would happen is we'll see another liquidity crisis a la March 2020, and then there will be some type of exotic central bank response up to and including a modification of the Federal Reserve Act and direct debt monetization. So you'd have this
And where they don't
flight
reach the
and
taper.
flight into dollars, and then this destruction of the dollar that
right.
takes a few more months to wash out.
Yeah, I think it take years, but same idea.
Yeah.
All right,
So they'll
caller.
simply just reduce their policies. I appreciate both of you. Thanks for having me on.
Yeah,
thank you so much.
Thanks for the call. All right, Robert, you got time for one more?
Let's do one more.
Okay. Hi, caller. You're on with Robert Breedlove. Oh, we can't hear your audio.
Hello, George. Hello, Robert. How are you?
Hi.
There.
Yes, I loved your series with Brent Johnson, with Jeff Snyder, with Andrew Yang. Yes, I want to talk about Bitcoin. And what few people talk about is the danger of public ledger like Bitcoin. It's very dangerous to have a public ledger where people can track on the blockchain where you send Bitcoin, where you receive Bitcoin, and basically what is your balance. And I think money should be private. I don't think that term privacy coin should exist. It should be surveillance coin like Bitcoin. By the way, I love Bitcoin. I think the Lightning Network is revolutionary, but we need coins like Monero to enter the mainstream narrative. What do you think about this?
Yeah, so I agree with you that privacy is a necessary feature of an ideal money. The issue with Bitcoin, insofar as I understand it, is, again, back to trade-offs. There's a trade-off between having a fixed supply, a verifiable fixed supply money, and having a ledger that's fully private. So you can't do both at the base layer for computer science reasons that I'm not qualified to articulate, but that's the case. So Satoshi optimized for fixed supply. Said, let's have fixed supply, perfectly inelastic money at the base layer, operating under the presumption that you could abstract privacy features into Bitcoin in higher layer protocols. And so you've properly identified the Lightning Network. Lightning Network obfuscates a lot of Bitcoin movement. Now it's always a cat and mouse game. There are analysis companies trying to work their way into the Lightning Network to probabilistically determine where you've sent your money to try and be able to track the movements of Bitcoin on the Lightning Network. But there are ways to use Bitcoin privately. So I'm not bullish at all, actually, on the privacy coins, because I think that fixed supply feature of Bitcoin is so important to the preservation of purchasing power and its competitive features as money, that it's going to just accrete more and more purchasing power as a result. And I guess I'm sort of just betting that this higher layer protocol development will continue to proliferate as it has. It's a very vibrant ecosystem. We've got all kinds of things going on in Bitcoin. And I should say there are things being done at the base layer that do increase anonymity as well, like Taproot was recently implemented. It just makes chain analysis more expensive, as I understand it. Like, it breaks some of the heuristics. And then the last piece is just, most people own Bitcoin through a KYC'd exchange, so their identity is attached to whatever balance they bought there. But there are ways to break that linkage as well. So it's not fair to just say it's a public ledger that everyone knows how much money everyone has. It's like, how much work have you done to anonymize yourself? So there's different cohorts of users. You can be anonymous if you choose to be in Bitcoin.
Well, I just want to say that I personally love Bitcoin because it has this aspect of very hard money, and
Exactly.
This is what we need. But I just want to precise that we have on layer one protocols that give very high privacy, basically perfect privacy. It's possible with zero knowledge proof and privacy. And the problem with Lightning Network is that you need the funding transaction, and when you close the channel, you have to put this on the blockchain. And chain analysis, cipher trace are really trying very, very hard and working with government to de-anonymize people, and they most surely will in a certain sense succeed. And yes, you can use Bitcoin with privacy, but it's very hard. One mistake and your stash of Bitcoin is tainted. And
Yeah.
also, Bitcoin has less value if your Bitcoin comes from a coin join or from any type of scam that happens. Your Bitcoin has less value. And I believe that hard money is what makes, even with these problems, Bitcoin very useful. Because if we put together Bitcoin and we use atomic swaps to um, to atomic swap between Bitcoin and maybe Monero or any other
Yeah.
privacy coin, we can give privacy to Bitcoin. And I think this is a very important conversation we need to have. First of all, that Lightning Network is not centralized; it's a genius protocol, and we need really to clarify this, that Lightning Network is very decentralized. It's a very smart way of using information to trade Bitcoin off chain. And this is just what I wanted to present here.
Yeah, I mean, that's a thesis, all right. And there's people that hold that thesis that we'll need a multi-coin future to augment Bitcoin's lack of privacy, and that's a possibility. You can bet on that by betting on those coins. I just tend to lean towards the camp of those alternative projects functioning effectively as a test net for Bitcoin. So if we do figure out some zero knowledge proof obfuscation technique that also preserves supply integrity, and that's proven through one of these side projects, that Bitcoin will ultimately absorb that feature, either at the base layer or the Lightning layer or a higher layer. So, maybe I'm a bit fundamentalist about it, but I kind of just see that it's like supply integrity first, and then all the features will coalesce to the hardest money. And that's my current thesis that I express by holding 100% Bitcoin.
Yes.
All right. Great,
Also,
great question. We appreciate it.
yes.
Yeah.
Just
Thank
one less small thing. Dogecoin actually is a good currency. Shiba Inu is a token on the Ethereum blockchain. It doesn't have even its own blockchain. But Dogecoin actually can function as money. It's a joke, but it can function as money. Just wanted to say that.
Well,
Thank you, guys.
Weird thing about money is it's whatever we choose it to be. So
Yeah,
sure.
Yeah. All right, Robert, thanks a lot for the conversation. I really appreciate you coming on live and answering a few questions. I think the audience has got a tremendous amount of value from all of your input. I can't recommend that they go check out your podcast enough. What is Money? Are you on YouTube as well?
Yeah, YouTube. I think it's under my name, Robert Breedlove. You can also go to what'smoneypodcast.com. And then my Twitter is at Breedlove22. There's links to everything there. George, man, thanks for having me. Love doing this.
Yeah. Have a great holiday, buddy.
Yep, you too, buddy.
All right, bye.